Fed. It's not 73, 74. But what is it? What is the character of this downdraft?
Well, I think the key characteristic here is the stagflationary environment that we've inadvertently walked into. I mean, we've had 2 years of helicopter money, and that was the easy way to deal with the crisis of the pandemic. But now we're paying the price for it with higher inflation. So I think that's the big difference. The stock market can't have a tapering tantrum here and expect that the Fed's going to respond, because inflation is much more severe than the past three tapering tantrums.
And Yardeni, how will corporations adjust? We're going to speak to Mari Bari here in a bit of General Motors, and whether it's something as staid as autos, something as sexy as Facebook and the rest of it, how do corporations adapt given these economic events?
Well, look, I know there's a lot of concern here that the risks of a recession have increased, and they certainly have increased. In my mind, they've come up from 15% before the war in Ukraine to 30%. But one of the reasons that I'm not convinced yet that we're going to fall into recession here is the consumer sector is in very good shape. And to your question, the corporate sector is in phenomenally good shape. You know, they raised over $2 trillion in the corporate bond market, the non-financial corporations have, and they refinanced a tremendous amount of their debt at record low interest rates. So as the Fed's raising interest rates here, there's still plenty of liquidity left over from the past 2 years of helicopter money.
So you said that there's about a 30% chance of recession. It's gone up since the start of the war. In the U.S. and this year, or is that through next year? What's your time frame here?
Well, I think, if you ask me about Europe, it's more like 50, 60% the way it's going, especially with this latest calamity.
For this year?
For this year, yes. For the 30%, I think it's more next year than this year. The leading indicators are still at an all-time record high, telling us that there's no immediate risk of a recession, though the stock market's certainly acting like it.
Well, do you agree with Bill Dudley and some others that if this ongoing momentum continues, that it will result in a more severe shock later on, a more severe crash later on, simply because inflation won't get contained and it will become more entrenched?
Not really. I mean, if you look at the history of inflation, it doesn't just keep going up and up and up. It's very spiky. Even in 73 and 79, we saw these spikes in inflation, and then they moderated. You know, the arithmetic of year-over-year percent changes is that when they are increasing at a very rapid rate compared to the past, at some point the arithmetic starts to slow them down. And I think we are going to see some moderation here in consumer durable goods inflation, which has really been the heart of the inflation problem. I think we're satisfying a tremendous amount of pent-up demand. Services have been relatively moderate. The problem is, within the services area, the rent inflation for the next 2 years is going to be going higher. So I think we're looking at higher for longer inflation.
At a completely unfair question, but I want to synthesize the original Yale University study of fiscal economics, which, folks, was literally a franchise of New Haven for decades. We've got the mother of all fiscal stimuluses, and then we bring it over to the monetary side, almost Milton Friedman-like, to an inflation study. What is your perspective of the duration of excess inflation given the fiscal impulse we've lived?
Well, my forecast is higher for longer inflation, but that doesn't mean it's not going to come down. It's just going to mean that I seriously doubt we're going to see 2% inflation anytime soon again, not in the next 12 to 24 months. But will it come down to 3 to 4% next year using the consumption deflator? I think so.
Is that doable? I don't mean to interrupt, but this is critical at Yardeni. This is Olivier Blanchard and Adam Posen. Can this nation, can our viewers and listeners survive a sustained 3.5% inflation?
I think we may very well learn to live with it. We've learned to live with COVID. I think we're going to learn to live with 3 to 4% inflation. But it's not necessarily something that's going to persist forever. I mean, that's sort of my outlook for next year. And for the financial markets, the stock market and the bond market, just seeing a peak in inflation, let's say by the middle of the year, early summer, would be very helpful.
As we talk about these big macro developments and this idea of the Fed hiking rates, I do go back to this case against Bill Wang of Archegos and this idea of leverage in the system. And this is unique, and obviously he's being accused by the U.S. Attorney's Office in the Southern District of New York of criminal acts. But it does raise a question about what else is out there with respect to leverage, with respect to our visibility. How are you viewing that in terms of what we can expect in the upcoming months?
Well, as we all know, the Federal Reserve has so far increased the Fed funds rate by 25 basis points, and we're in the range of 25 to 50 basis points. And yet the markets are already discounting that there's something's going to break here when the Fed really starts to move more aggressively. And everybody expects that in the early May meeting that the Fed's going to go and go ahead with a 50 basis point increase. And the market's got this jitters like something is going to break. And I see like $3 trillion of excess liquidity left over from the past 2 years of helicopter money. But the markets have their own agenda.
Well,
they don't listen to me.
To take that a step further, Ed, do you think that the safeguards in place to avoid something catastrophic or some sort of systemic meltdown stemming from leverage really are secure enough to prevent that kind of action, that perhaps people are taking the wrong lesson from previous times because this system is much safer? Is that your interpretation?
Well, at the risk of being dead wrong, that is my interpretation, that the system is more robust. The banks are in great shape. Corporations are in great shape. Consumers are sitting in a tremendous amount of M2, and most of it is in demand deposits. Look, not everybody's well off and doing well. I mean, clearly, inflation is eroding everybody's purchasing power. But in terms of something breaking in the credit system, I just don't see it. I'm watching the junk bond yield to see whether that's going to signal some real serious problems. And so far, it's pretty calm.
Ed, we're going back to Arthur Burns' inflation move, rate moves, 50 beeps. Some people talk 75 beeps as well. Did that work out the last time?
Well, the Burns environment, of course, is what we go to look at the Fed raising interest rates too little, too late. And then eventually Volcker came in the late 1970s and just let it rip, let interest rates go up to levels that cause a recession. I mean, we do know that recessions always bring inflation down. But whether we can achieve a soft landing is the big controversy here. I suspect that we either do or we get a real short and moderate recession, again, because I think the system is relatively robust.